Good morning, Rare ECN listeners. This is your Forex market commentary brought to you by Rare ECN. Today's discussion, we're going to examine the euro-dollar market. First in line with this discussion, we're going to break down the technical front on the euro-dollar hourly time interval. Having a look at this chart here, analysis of a collection of technical indicators on the hourly time interval on the euro-dollar market suggests a temporary bullish market sentiment and recommend long positions on the euro. The hourly charts show that the single currency opened today's Sydney trading session midway between its established short-term Fibonacci resistance at 1.3924, while the Fibonacci support is set at 1.3900. The euro-dollar map against the Bollinger Band indicates high volatility in this market as the gap between the upper and lower Bollinger Band is wide, extremely wide. The pair continued to trade above the 200-day simple moving average during last week's trading session, and this long-term bullish momentum is carried forward into the beginning of this week's trading session as well. This trend action holds great significance as 200-day simple moving average contains more or less of 1 year's worth of trading data and the forecast long-term market sentiment, and currently the pairs are trading above the 200-day simple moving average, which is indicative of a long-term bullish market sentiment on the cross moving forward. This bullish view is also validated on the short-term moving average front on the euro-dollar pair, opening today's trading session above the 5, 10, 20, and 30-day simple moving average. Collectively, this is indicative of a buy recommendation on the technical front. Having a look at the RSI indicator on this hourly chart, it showed that the bullish momentum may gain traction if the RSI can break out from the upper 50.00 price value range. This week will be a full pack-on risk event for the Eurozone as well as the US market. On Monday, we have the Eurozone CPI year-on-year forecast to be at 0.8%, while core CPI year-on-year is forecast to be at 1%. Also, US industrial production month-on-month is forecast to be at 0.1%. Tuesday, we have the ZEW economic sentiment for Europe. Is forecast to be at 67.3%. The U.S. building permit forecast to be at 0.96 million, while U.S. core CPI month-on-month is forecast to be at 0.1%. Wednesday is the most highly anticipated risk event, which is the FOMC meeting. U.S. interest rate benchmark is expected to stay at 0.25%. This will be Janet Yellen's first FOMC meeting as well as her testimony and projection release of the U.S. economic outlook for 2014. On Thursday, we have the U.S. existing home sale forecast at 4.61 million, as well as the release of Philadelphia Fed Manufacturing Index expected to be at 3.8%. So let's touch on the fundamental front on the euro-dollar market. Risk on and risk off theme has been the driving the rally in the euro-dollar market over the past week. The euro-dollar pair is highly sensitive to risk appetite. One example that can jeopardize risk appetite is Crimea referendum vote to whether to join up with the Russian Federation or remain as part of Ukraine. The development of this issue can lead to risk aversion in the case that escalating tension re-emerge, thus subsequently causes investors to reduce the risk appetite and exposure to emerging market or riskier asset in favor of safe haven Japanese yen or US dollar. Another pending concern to the longevity of this risk appetite are current market conditions, which are dubbed by highly leveraged or greater exposure to risk at a time where OECD, central bank, also known as the global liquidity provider, are slowly trimming back the stimulus package or reducing the dovish undertone on monetary policy. The reason that underlines investors' appetites to multi-year high in riskier asset exposure is the moral hazard guarantee set by central banks since the financial crisis in 2008. Therefore, this backing of large financial institution by which central bank has cultivated investors' perception towards risk. The elevated level of the euro seen over the past week can be largely attributed to the ECB refusal to implement additional easing program despite remaining accommodative. Both the World Bank and the IMF have worded their opinion on the eurozone, suggesting that the ECB should become more aggressive and cut rate to accommodate the sluggish eurozone economy. Nevertheless, the ECB has not followed through with its ideology. Thus, this allowed the market to revise the sentiment on the euro to bullish on the low to mid-term range. When comparing this against the backdrop of the Federal Reserve, whom are tapering and trimming their stimulus program, it should make the greenback more attractive than the euro on the relative monetary differential standpoint. However, this is not the case. Another component in this euro strength equation can be linked to China and Japan gradually diversifying their large currency reserve out from the long-term U.S. Treasury into the eurozone. An example of this capital inflow into the eurozone can be seen in Spanish and Italian government bond yield curve sitting at multi-year low. In addition to that, eurozone current account grew to 33.2 billion euro in the month of December. An expansive current account number is indicative of capital inflow. ECB President Mario Draghi tried to talk down this elevated euro level last Thursday. He expressed concern that the strength of the euro can hinder the eurozone export competitiveness, especially the peripheral countries that are haunted by slow growth and high unemployment rate, therefore largely dependent on export market to grow their way out from this recession. However, the recent upbeat in eurozone factory activity contradicts Draghi's statement, thus the market shrugged his comment off. Across the Atlantic in the United States, traders are anticipating the March 19 FOMC meeting. This will be Janet Yellen's first FOMC meeting after taking on the role of the new chairman of the Federal Reserve. During this meeting, the market are expecting an announcement of tapering by another $10 billion as well as economic projection for 2014. Since the beginning of this year, leading economic indicators consistently underperform against the market forecast, while at the same time the Fed official continue to remain committed to the continuity of tapering. They attributed to the weak economic data for the month of January and February to the extreme weather. Therefore, it does not substantiate an argument to a change of the course of their monetary policy. The importance is placed this week on the FOMC meeting as the Fed will explain its viewpoint after digesting a string of recent economic data. Thank you everybody for your time and stay tuned for the next commentary. Have a good day everyone.